Yeah.
Thank you for joining us. My name is Joe Terril. I'm president of Terril and Company, independent wealth management firm in St. Louis, Missouri, with about $700 million worth of discretionary monies under management. Today is Tuesday, March 11th, and we wanted to use this opportunity to update everyone on what our thinking is, not only on the world economy, but also on the investment markets. And I appreciate Brian Curtis helping me with the video, and we'll get it posted as soon as we can. And we'll maybe start out chatting just a little bit about the world economy. So with that, Brian, when you're ready, just let me know. There's been quite a bit of debate recently about the world economy and whether it is slowing down enough that it will have a meaningful impact around the world. In particular, growth in some of the truly emerging markets economies such as China and Brazil and India. Our take on that is that there is some slowdown, but not enough that it's going to have a meaningful effect on corporate profits or worldwide GDP growth, and it certainly isn't going to have an effect on inflation and or the interest rate structure. We continue to believe that we will see reasonably good worldwide economic growth. Intrinsic demand around the world for goods and services is definitely there. It's not smooth as can be in a stair-step type fashion, but yet the demand is continuing to go higher. With that said, we're a little more optimistic on the economy in the United States than some. We believe the second half of this year will show better growth than the first half, and we've already been affected in many ways by the weather. It's been a very brutal winter all over the country. So we're continuing to think we'll see nominal growth somewhere in the 3.5% range. With inflation added in, of course, we'd be closer to something around 5.5%, 6%. So we're not real concerned about the economy. There's always events that are going to have some influence. The events going on right now in the Ukraine and the Crimean Peninsula, the disappearance of a Malaysian aircraft that no one particularly knows what did or didn't happen, the effects of the Chinese New Year and some of the recent weakness out of China. Is it related to the Lunar New Year or not? So put all those things together, we don't see anything out there right now that is really going to have a permanent interruption on the intrinsic demand for goods and services around the world, which should keep the economy around the world doing okay. One thing of interest on the international scene in the economy, which will lead us into talking maybe about investment markets, is the fact that interest rates around the world in countries where previously interest rates were much higher have fallen dramatically. In Ireland, the yield on 5-year Government of Ireland bonds is actually lower than what it is in the United States. And recently, 10-year Italian bonds had a dramatic drop in yield. I believe this is a characteristic of the fact that there is so much capital around the world chasing too few investments. In other words, there's more supply of money than there is investments for it to go around. This has somewhat changed our thinking at Terril and Company about what future interest rates will probably do in the United States. But we're getting ahead of ourselves. Brian will switch now maybe from talking about the world economy, the economy in the United States, to maybe talking about investment markets.
Okay.
As it relates to investment markets, we continue to be mildly bullish. We've had this approach for maybe the last 18 months. Certainly last year in 2013, we were not bullish enough. Even after the gains we saw last year, I believe that we can see maybe 5% to 7.5% gains this year. This is predicated upon one simple fact that we were discussing a few minutes ago. There is a tremendous amount of capital around the world chasing after the same investments. And I hear many times people talk about all the reasons why maybe stocks should go down, historical valuations, different pricing models and comparing them to previous time frames. I really don't put a lot of stock, not to make a pun, but I don't put a lot of faith in any of that, because we've never existed in a world investment market like we have right now, where it is one market all over the world shopping for the same investments all over the world. It's not a domestic United States market any longer. I've said it, but I'll repeat it for maybe those that haven't heard me say it before. About 7 of every 10 transactions in the United States in our markets, whether it's stocks, bonds, or in between, comes from overseas. So it gives you a feel for just how much activity is coming from around the world. And therefore, we've never been in this environment where interest rates are basically zero all over the world. And we've never been in this type of environment where perhaps our markets, as much as anything, are going to be dominated on what foreigners think the right prices are. And this, if you haven't heard me say it, is a good thing. This international investment of the markets, etc., is a positive, both from ultimately economically, financially, for our markets. I'm really pleased that around the world we continue to see the markets develop in this fashion. So, in a nutshell, I think that people around the world that previously had not had as much of an influence on the United States markets as maybe they do currently, they're used to paying much higher prices historically than what we've paid in this country. Those prices don't look that far out of line to them. And in addition to it, it really comes down to a simple question that I would ask somebody that doesn't think market's going to go higher, that the markets are going to go higher. And my question would be, where are they going to put the money? This constant amount of capital that's being generated all over the world, just the reinvestment of interest and dividends without new principal coming into the equation, what are they going to do with it? It's got to go somewhere, and they've got to invest it somewhere. And until something changes on the world investment scene, we continue to believe the United States and our markets will benefit from a lot of that money coming into our markets, and consequently that's why we think, even though we've had some pretty nice gains, and if you looked at previously just domestically how we priced issues, you would say we're at the top end of the range. But that's got nothing to do with the fact that there's so much capital around the world looking for a home. We think they can drive prices, particularly of equities, maybe 5% higher. We've been pretty negative on bonds for the most part correctly over the last year and a half. But we're trying to do a little bit of work now on if the Federal Reserve Bank stops quantitative easing, which they're going to do at some point, what would that mean to interest rates in this country? Therefore, what would that mean for fixed income investments and the prices of fixed income investments in the United States? And we haven't come to a firm conclusion, but we're a little less negative than before because I think any material increase in interest rates in the United States would attract a tremendous amount of the world's capital in a hurry, which would prevent rates from going very high. So we'll see. I'll report to you in future written comments or future podcasts, Brian, that you and I will do. What conclusions we're coming to in this area. So for the moment, we're neutral. We're not pounding the table on fixed income investments, bonds, and such. But I do think there's an interesting environment developing around the world of the fact that interest rates are falling so dramatically in some of these small markets. I've got to think that capital would quickly come to the United States if our rates went up. So we'll see about that. And we remain constructively positive on stocks, neutral on bonds. And we think it's the type of year where maybe we can end up with 6 or 7% type rates of return. Thank you for joining us today. Once again, I'm Joe Terril, president of Terril and Company in St. Louis, Missouri, independent wealth management firm, investment advisors, with about $700 million in discretionary funds under management. And we will be updating these video casts on our thoughts probably once every 4 to 6 weeks. But in the meantime, if anyone does have any questions, particularly our clients and people who like to follow and know what our thinking is, don't hesitate to contact us. And we thank you, and Brian, I thank you for handling the film duties.
Oh, you're welcome.